You might have heard inflation in Europe is coming down. That's true, headline numbers stayed low and stable, and even though core inflation was a bit hotter than expected, the trend still points toward further deceleration. But if you think that's the big economic story this week, think again. Because right now, the real action in Europe isn't just about prices. It's about tariffs. And more specifically, how the European Union is responding to a dramatic shift in US trade policy. Let's rewind. On March 12, the US slapped a 25% tariff on steel and aluminum products. Sound familiar? It's a move that mirrors what happened back in 2018, but with two major differences. The rate is much higher, and the range of products is way broader. Back in 2018, those tariffs hit about 6.4 billion euros worth of European exports, adjusted to today's prices, maybe 8 billion euros. But this time around, the target is 26 billion euros, more than triple. That's about 5% of all EU exports to the US, based on 2023 numbers. Naturally, the EU didn't just sit back. They brought back their own countermeasures, the so-called rebalancing tariffs. Remember the tariffs on American whiskey, motorbikes, and other symbolic goods? Yeah, those are back. And they've expanded the list, now covering 21 billion euros worth of US exports. That's roughly 7% of what the US sends to Europe. But then came the plot twist. In early April, the US took it a step further. They introduced a region-specific tariff regime, including a flat 20% tariff on all EU products. That was a major escalation. But within a week, just days later, most of those new tariffs were suspended for 90 days. During that time, a universal 10% tariff was put in place for all countries except China. In response, the EU also suspended their planned retaliation. So for now, both sides are in a holding pattern. But here's the thing, even with those suspensions, the effective tariff rate on EU exports to the US has jumped from just 1.5% in 2023 to around 12% today. So what's next? Well, it looks like the door is open for negotiations. The US has already floated the idea that tariffs could come down from the 20% originally proposed. And the EU? They're looking for ways to strike a deal. One possible avenue is energy. The EU currently imports about $14 billion of natural gas from the US, plus another $55 billion in oil. That's roughly 15% of their oil imports and nearly half of their gas imports. Some EU officials have suggested increasing purchases of US energy products as a way to reduce trade tensions. A figure of 50 billion euros in additional purchases, including both energy and agricultural goods, has already been floated. That's a number that lines up more realistically with the US-EU trade deficit, which sits closer to $230 billion, not the $350 billion goal some US officials have thrown out. Could this be enough to strike a deal? Maybe. But it's also clear the EU is preparing for a worst-case scenario. If talks break down, they're ready to roll out more countermeasures. That means higher tariffs on American goods, more trade barriers, and even a possible tit-for-tat escalation. But let's be honest, nobody really wants a full-scale trade war. So what does all of this mean for the economy? In the best-case scenario, where the effective tariff rate stays below 10%, and the EU limits its retaliation, euro area growth would take a modest hit, maybe around 50 basis points spread over 2025 and 2026. Not great, but manageable. That's what economists are calling the benign scenario, but there's still one giant question mark hanging over all of this: the US-China trade relationship. See, the outcome of EU-US negotiations will also depend heavily on what happens between Washington and Beijing. If the US keeps tariffs high on Chinese goods, the global trade environment could stay tense, and any EU deal might be short-lived. On the other hand, if the US and China manage to cool things down, it could open the door for a broader de-escalation. Our policy team gives a 60% probability that US-China tariffs will eventually come down. But it won't happen overnight. Meanwhile, the risks to European growth are skewed to the downside. Even under the optimistic scenario, we expect growth momentum in Europe to bottom out in the first quarter of 2026. So yes, things might get worse before they get better. But here's the key point: this isn't 2018. The stakes are higher, the numbers are bigger, and the geopolitical backdrop is way more complex. But at the same time, the willingness to negotiate appears stronger too. Both sides know that a prolonged trade war would hurt everyone, and that's why energy deals, agricultural imports, and even defense purchases are all on the table. The next few weeks will be crucial. The 90-day suspension ends in July, and if no deal is struck by then, we could see tariffs snap back to the 20% level or even higher. That would hit European exporters hard and could trigger another round of retaliation. But if a compromise can be reached, say, tariffs closer to 5 to 8%, plus some symbolic EU purchases of US energy, we might just avoid the worst-case scenario. So as the headlines keep coming, and investors try to price in all the possibilities, here's the bottom line. Europe's inflation outlook is improving. Growth remains fragile. But the real story to watch right now? It's the tariff negotiations, because they'll shape not just trade flows, but inflation, business sentiment, and ultimately the path of the recovery in the euro area. Keep an eye on July. That's the real deadline. And what happens between now and then could define the next chapter of Europe's economic story.